Right, right. So let's talk about risk management. Right. So today is day 15. We are officially halfway into the call, and we are halfway into the 30 days YouTube mentorship. And today we will not really spend so much time because yesterday was a long one. And please, if you have not gone through the previous videos, do want to go through from day 1 up to day 14. Right. Very packed teachings, and I'll like you guys go through it at least 2 times so you can get a better hang for what's or a better feel for what you're doing. All right, so do how to go through the previous 14 teachings before heading over here so you can get a better understanding of what you are doing. All right, so let's go into the topic of today. So today we're talking about risk management. That is something that many mentors don't talk about. Just keep telling you strategy, 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 strategy. And you have to understand that risk management is one of the core components to successful trading, right? Risk management is very, very important. Very, very important. Right? Very, very important. So when you're talking about risk management, we are referring to how you allocate your risk or how you manage your equity or your capital, right? So risk management is very important because it determines almost everything, right? Because someone can someone can win 5 trades and then lose one, and with that one loss, he has lost everything that he made because there was no risk management. Meanwhile, someone can win. Let's just do the maths here. Now, this is why risk management is important because he keeps you profitable regardless your losses, right? Someone can risk, someone can win 5 trades, someone can take 5 trades now, can take five, and then he wins four, and then that loses one, and that one loss will end up losing you end up losing everything with that one loss. Let's say that his 4 wins, he won, and let's say he won uh $10 per trade, right? So that means he won $40, right? So he won $40 on his 4 trades. And then the one loss, because he did not understand his management, that loss one and loss was 50. On the one loss, maybe he thought that because he has been on a win streak, then he should increase his risk or he should over leverage. And then that one loss is now doing what? Wiping out everything that he has won. And this is why it is important to manage your risk because you can win 4 trades and make profit and then lose one and then lose everything you have made because you don't understand that risk management is the holy grail. And this is the holy grail trade. Why someone else can still take the 5 trades and then he wins two, just two, and then he loses three, right? And that person that loses three, that person that loses 3 trades, he's losing only $30 in his 2 trades. He's losing only $30 in his 2 trades, right? He's losing only 30, and the person that won, his wins are only what $50, right? So his average win for the trades is what $25, and each win he's winning $25. So he now said, okay, he wins 50. So you can see that this guy won 2 trades and lost three. Why this one won four and lost one? But you can see that the one that won two is more profitable than the one that won one. And this is the power of risk management. Risk management is simply losing less and winning more. That's the simplest definition of risk management. Proper risk management, or let's say the goal, that's not the definition. Definition of risk management simply means allocating risk to individual trade. That means any trade you take, you must allocate a percentage of risk, right? And now note this, the percentage of risk you allocate to your trades must be uniform, right? That is how to make risk management work for you. So whatever you're risking, it has to be uniform. Not that you're risking $10 today, tomorrow you're risking $20. So your risk must be uniform, right? It must be uniform, it must be similar. So if you're risking 1%, it has to be 1% or two on all your trades, regardless of regardless if the trade is actually a high probability or a low probability or whatever the case may be. You have to have a uniform risk. You must have a specific uniform risk. Very important. For you to have that consistency, you must have a uniform risk. The risk must be uniform. And the second thing that you must do for risk management to work for is that your win ratio, your win, let's say your risk reward, your IR, score risk reward must be above 1:2, right? Must be 1:2 and above. This is one of the things that you must put in place. Now, I'll tell you why. So for you to have what risk management to work for you, number one, your trades must be uniform. Your risk must be uniform. That means if you're taking, let's assume that maybe you bought a profit account for let's say $10,000 and maybe you're risking 0.5%. That is $50. That means your risk must be uniform. That means all your trades should be $50 per trade. Maybe until the end, that will be till you pass the account or till that's life funded. So your risk has to be uniform. So that your risk can work for you. So on every account, you must have a uniform risk. So if you're risking $10, let it be $10 all through, or else you fall into the trap of what? Using one trade to lose all that you made, right? That is why you have to make uniform risk. Because if this guy was using uniform risk, then this one loss should have been what? This one loss should have been what? Should have been $10. Assuming he's using 1:1. His loss should have been was $10. Since each win is $10, that is $40. His loss should have been $10 or even five because you have to risk more than less than what you're making. Right? You have to risk more less than what you're making, what you're potentially going to make. So this is how his loss should have been. Since each win 1:2 is $40, that means each win he's winning $10 per win and $1, $5 per loss. This is how his loss should have been. Right? You should always your risk reward must be above 1:2 to be profitable using risk management. Anything you're taking, your reward should be at least 1:2. That is double of what you're risking. That is the reason why many people are profitable with few trades. Now, I did an analogy on my Twitter page, and I want to bring that analogy to you guys. Now, let us look at these various things. Now, if you use 1:2, let us look at the goal, right? If you use 1:2 now, let's say you use 1:2. If you use 1:2, right? If you use 1:2, you just need only what? You just need to win four, right, out of 10 to be profitable. So you have to win just 4 out of 10. So that means if you take 10 trades and you use 1:2 for all your trades, that means whenever you win a trade, it is 1:2. And whenever you lose a trade, it is -1, right? So you just need a 1:4 out of 10 to be profitable. So you just need to be 1 of 10 to be profitable. Make profits. I had to profitable. Right? You have to just win 4 out of 10. That means if you just win 4, you're profitable. If you're using 1:2. And let's do the math. Now, if you do the math, if you maybe you risk $10 per trade and you win on 4, right? You win let's say you win sorry, you risk $10 per trade, you risk $10 risk. Remember it was winning from you. So you do $10 risk. If you win 4 trades, that means you're upwards. $8 because it's 1:2, right? Remember that you have to hit at least double of what you're risking. So you're winning $8, and then let's say you lose the remaining 6 right, out of the 10. So now you're losing 60 simply means that you have lost what? You have lost only what? $60. So you can see that at the end of the day, you are net profitable, right? At the end of the day, you're what? Net profitable because if you subtract 60 from 80, you're upwards $20, right? So another idea is that you must what? You must have what a probabilistic mindset. That means you must take your trades from a series of trade perspective. I have to take series of trade perspective. So we don't have to put too much priority on one single trade, right? If you're taking 10 trades, then you're looking at the big picture. Okay, let me just win 4 out of 10. Not that you're trying to win every single trade because all you need to be profitable is just to win 4. If you take 10 trades now, all you need to make profit overall is just to make 4. Let's assume that in a whole year, as you're taking only 10 trades for a whole year. All you need to do is to win 4. Once you win 4, you're done. You have won, you're a winner, right? Once you just win 4 out of 10, you're a winner. So always see your trades from the sample set of what? At least 10 trades. Or some people use 20. Some people prefer 20 because 20 is a lot more wide. But I like to use 10 because 10 is make easier to calculate. So when you're taking 10 trades, just use 1:2. You just have to wait for. I know that winning 4 trades out of 10 is very easy if you're using 1:2, because if you're if you are using 1:2, you have more chances of getting wins, because the markets will likely go for 1:2 than to go for 1:3 or 1:4. So using a ratio as little as 1:2 gives you more accurate wins, right? So that is it. So meanwhile, if you're using 1:1, let us talk about 1:1. So if you're using 1:1 now, 1:1 requires that you have to do what? You have to win 6 out of 10. So you have to win 6 out of 10 to be profitable using 1:1. So if you win six, let us use that same analogy. If you're still using that $10 risk, so using that $10 risk, I mean, your wins, right? Remember that your win will not be what? Your win on six. Your 6 wins will be what? It's not be what? $60, right? $60. Since it's 1:1, right? And anything you risk can make it exactly what you risk. Right. So now you see that 1:1 is $60. So wins 6 out of 10, sorry. So now if you win four, I mean, say if you lose four, I see that you have lost $40. So you see that if it's 1:1, it requires you to have a very high win rate. You have to win 60% of your trade. So you have to backtest and know how good your strategy is and know which one you want to go for. So if you're using 1:1, you have to win at least 6 out of 10, which is really a lot. And if you ask me, I prefer using 1:2 or 1:3, because I don't have to win this much. Because winning 6 trades out of 10 it takes a lot, right? So let us also copy this analogy and use the same analogy for what? For the next point, which is what? The one I actually recommend for beginner traders, which is very, very good. You have to use this one if you're a beginner trader. So it's very, very important to use 1:3. So now let us use 1:3, right? So now 1:3 is one I recommend. Very, very recommended. This is the one I recommend for a trader. So 1:3 is recommended. Very, very heavily recommended. So 1:3 heavily recommended. So in this one, you're still using the same $10 risk. Remember, very, very powerful, very powerful. So now if you win those 3 trades using $10 risk, so your winning was $90, because each trade is for times three. Remember, you're using 1:3 now. So if you're using this, then that means $90 win. And then if you lose 7 out of 10, right? Remember that if you lose seven, then you're upwards just minus 70, right? So $7 loss, right? This is the minimum threshold for it. So $7 loss. So remember, you see the math for it. The math for 1:3 becomes very, very nice, because just winning those 3 trades, you're still profit, because if you do 90 minus 70, you're up for $20, right? So 1:3 we usually give you a lower win rate, but when you win, you're really making a lot of money. So you have to learn how to um, use the risk management to your advantage, because 1:3, you're making $30 per trade. So if you win 3 trades, you're upwards $90. And if you lose seven, remember that you're risking $10 per trade, right? So you're losing 70, right? Remember that what you're making is times three of what you're risking. So you can see that when just 3 trades have made you profitable out of 10. So 1:3 is very recommended. So if you're just beginning, you don't have a very good win rate. All you have to do is to have just win your 3 trades out of 10. That is all. You're just winning only three. So we can just win 3 trades out of 10. You're very, very profitable. You don't need to trade. So once you take 10 trades, you're only looking to win three. And the three you're looking to win, you're not forcing any trade. You're all treating each trade individually. Each trade is individually and different to you, right? Each trade you take, you're giving what you're not putting so much priority on it, because any trade can be a loss and any trade can be a win. I have to repeat that. Any trade can be a loss and any trade can be a win. For the last time, any trade can be a loss and any trade can be a win. So don't put too much priority on any trade, because any trade can end up a loss. No matter how good the setup is, it can end up being a loss, because that is how the market operates. So you have to learn to spread your risk across different trades, right? Spread your risk. And you know that this is the minimum. You can always win 4 trades out of 10. You can always win 5 out of 10 to be more profitable. I'm just giving you guys the minimum requirements. The minimum requirement for 1:2 trades is what? 3 trades. The minimum requirement for 1:1 is what? 6 trades. And the minimum requirement for what? 1:2 is what? 4 trades. You can see that the difference is just the difference between 1:3. Right? You can see the difference between 1:3. Let us go this way. Consider the difference between 1:3 and 1:2 is just one trade. So if you can just win one more trade out of four, then you can go for 1:2, which will give you what a higher win rate. But many people think that 1:2 is not that profitable. 1:2 is very profitable. If you can just win 4 out of 10, you're good to go. And 1:2 usually mean that you have what? You'll be winning what? You'll be having a kind of higher win rate because it is easier for the market to go 1:2. Because if you like maybe you take a buy, right? So you take a buy, right? Right? It's easier for the market to hit 1:2 than for the 1:3. The market cannot simply just go 1:2 with the following ones reversing. So it's easier for the market to go 1:2 than this volatility to go 1:3. So 1:2 usually gives you a higher win rate than 1:3. So with 1:2, you'll be winning more trades than 1:3. But with 1:3, you'll be making more money than 1:2. So if you're able to tweak your strategy to win more trades, like if you can tweak it to have more wins 1:3, then you should do 1:3. But if your strategy can deliver 1:2 very easily, just go for 1:2. So you can always go for 1:5, 1:6, 1:7. They are also very good. I'm just giving you guys the best case scenarios, right? When you're not trying to make too much. Like people that make as much as 1:11, 1:15, and those kind of trades will just take a lot of time, and the win rate for that is very less because um the chances of markets going 1:10 is low compared to market going 1:2. So 1:2 and all these lower risk managements, all these lower risk reward ratios keep stress away from you, right? And let's take 1:2. And another thing you can do is to take partials, right? So if maybe you want to go from 1:10, you can always take partials along the way. Maybe as market even eat 1:3, you take 50% off and then allow it to go from 1:10. So that is more profit for you. So you can always do that. So that's another way of managing your trade. You can also decide to go break even and then hold the trade, right? It's very you can also do that. So when market hit 1:2, 1:3, you can take 50% off and then hold. Maybe if maybe your setup now, maybe you're trying to buy to this high now, right? Trying to buy from here to that high, right? And maybe from here to that high is from here to that high is from here to that high is what? From here to this high is what? One is to let's say 1:10, right? So you can decide to do is to take partial. Maybe if you buy a stop loss below the low, right? I can allow some of this now. You can also decide to do what? To go and hold your trade um all the way up, right? You can try to hold your trade all the way up, 5, 2. All right, so you can try to hold your trade all the way up. So maybe you go to your risk. You can maybe decide to go for maybe this, I don't know, this market is wasted is 1:8, right? So you can try to take partials at 1:3. As market hit 1:3, you just take off your partials and then hold for the overall high. So that is still very recommended too. If maybe your target is so far, all right, and you don't want to miss money. So you cannot simply do what? As market goes 1:3, 1:3, 1:4, you cannot simply do what? Take off something, maybe close maybe 50% or close 70%, and then allow the rest to go because this rest will give you more profit. So you must not hold your trade to give you one full 1:8. You can go take off take off partials and then allow the rest to run because it's now more profit for you. So instead of winning $10 on the trade, you can win as much as $50 on one single trade because you're holding to the end. So if maybe you hold 1:3 and maybe you took partials at 1:3, let's assume let us do the math now. Right? Let's say you have 1:8 trade, right? The market is 1:8, right? 1:8. The market is 1:8. So you have a 1:8 trade, right? 1:8. So now you risk what? Let's say you risk on $10, right? You risk $10, right? So you see, let's say you risk on $10, right? I don't know, not so much. So you risk $10. If you risk $10 now, and the market goes 1:8 is $8, but you don't want to hold for the whole trade at home because it can reverse on you, right? So you can say okay. So you can say, okay, let me close partials at 1:3. So when the market hit 1:3, you have secured what? So 1:3, if you go 50% risk, you have secured what? $30, right? So if you go 50%, so if you risk $10 and take partial at 1:3, you have secured what? $15, right? So you have secured what? $15. So it's $15 secured. If you take partial at 1:3, you have secured what? $15. Remember, your targeting 1:8 now. Remember the goals we're talking about. Targeting 1:8. You're targeting 1:8. and then you take partial at what? At 1 is to what? At 1 is to 3, right? You take half, like half of your profit at 1 is to 3. So doing that simply means that you have secured what? $15 out of each trade. That means if the market should take you out, and when you do that, you can go break even. You can move your solo to your entry and then go break even. So now this means that even if the market reverses on you, you have still was secured at $15. So now if you want to hold for the full to it, so what will happen? So if the market should hit full TP after your second full your full 1 is to you have secured your full 1 is to 3, right? So what this simply means is that when the market hits final TP, right? The market should hit final TP, right? So you're going to make extra $40. So in this trade now, you're not making what 40. You now make what if the market should hit TP, you make what an extra what $40, right? So you're making an extra $40, which if you compound it, if you add it to what you have, right, you have made what a whooping $55. So you're making what $55, right? So if the market should hit TP at 1 to 8, you have made extra 40. So now what do you have? You now have what? $55. 40 plus 15 is what? 55. So this happened by what? Taking partial. So you are targeting 1 is to 8, but you risk $10, right? So instead of holding for the full $80, because market can reverse on you, you just simply what went half at 1 to 3. At 1 to 3, what went 50%, and you secured what $15, right? Remember, at 1 to 3, you went a half, you took half, which is what $15 out of 30, and then you held to the end. So you have made what $55 by doing what by risking what $10, right? You have made was 50, and this is 1 to 5 for you. So that is the power of taking partials. So you can choose to take partials if you want to hold the trade for a long time, because if you take partials, even if it ends up reversing on you, you didn't take any loss. You're still was profitable, right? So taking partials help you be profitable even when the market reverses on you, because you can't know for a fact if the market will go your way or not. So you have to always do what learn to protect your profits. So even if you don't want to be, even if you want to be swinging trades, it's best to take profits. You take partial, you take 50%, you take 20%, you take something off as the market delivers to you. And maybe you can take 50% off all those things, right? It's up to you. Just learn how to take partials. Maybe you can take partials at above previous highs, maybe maybe at some Fibonacci levels, maybe at 50% take partials. As market take out a new high or a new low, you take partials. You can always take partials. It helps you to do it to make more profit on a single trade. Why doing what? Why risking less? So you're making more profit on what? That same trade. While you're risking less, and you're not risking more, you're still risking the same risk, but you're still making what times 5.5 because what you took partials. So it's very, very important that you take partials. So you can choose to be taking partials and going for a bigger RR, or you just simply take 1 to 3 and walk away, right? You must not hold your trade to the whole 1 to 8. You can simply say, okay, for me, I'm taking 1 to 4 and I'm done. I'm taking 1 to 3 and I'm done. So it's up to you to decide what you want to risk and what your reward should be. Right, so I wish you guys the best, and so I hope to see you guys tomorrow's teaching. So have a wonderful day. Cheers and God bless.